There is no such thing as support and resistance level. You know, when I first heard that, I thought, what kind of crap is this guy talking about? First, what are support and resistance levels? Support's a level or an area on the chart under the market where buying interest is sufficiently strong to overcome selling pressure. As a result, a decline is halted and prices turn back again. Resistance, just the opposite of support. To this day, I still think this guy was wrong, but there's a lesson to be learned by the fact that this experienced trader would make such a claim about such a well-known technical analysis. Now, the way that many traders view levels is as support and resistance turning points, where they can take trades and define their levels of risk. Number one, you identify a price or a price zone that has historically supported price. Second, you believe the market will move higher from this area. 3, you go long at this zone and you place your stop below the zone. Does that sound about right? And from a trading risk standpoint, it makes sense as you know when you're wrong and how much you can lose. Now, that's disregarding any sort of slippage. But you know what? It's not the best way to trade support and resistance, and here's why. Because every moment is unique in the market. Trading based on levels alone is like trading with blinders on. It's easy to identify specific prices that have historically demonstrated their value as support or resistance, and the temptation which follows is to take a trade at the price when the level is revisited. But this could be a disaster. Are the same traders who turned the market before going to be there again? Are the same market conditions present? Is the context the same? And when I'm talking about a level of support or resistance, I'm not talking about mathematically generated levels. We're not talking about pivot points or Fibonacci retracement. We're also not talking about trend lines as a means of determining support and resistance. Now, even though trend lines are popular, there are many trading examples where a downsloping trend line will break to the upside and run straight into a horizontal resistance zone. What I'm talking about are price levels where actual trading activity has previously entered the market and prevented prices from rising or falling further or started a larger move. Now, these levels can be weak just as they can be strong. Weak levels can hold just as strong levels can fail. So what any level is in reality is a reference to previous trading activity. Sometimes the market will turn from them. It'll break them. It'll push through them by just enough to stop you out before it reverses, otherwise known as a false breakout, quote unquote. Now, whatever the market does, by observing the action at or around a level, you're able to find context with which you may be able to identify excellent trading opportunities. Now, there's a problem with drawing trend lines for support and resistance. And I know some chartists will challenge me and say the use of trend lines are great, but you're going to find that many long-time chart technicians have forsaken the trend line, not only for support and resistance, but also the chart patterns that use them. Why? Well, let's explore this example. Let's take a look at trend lines and the main issue with them. Now, after 2 peaks, I'm able to draw a trend line to connect the points. Traders that play breakouts of trend lines will monitor price as it breaks the line. In this example here, each break of the trend line rallied, but it stopped dead in the tracks right near the horizontal resistance line. If you were long, this would have caused you grief as the market continued to pull back against you. It wasn't until price consolidated under the horizontal resistance line, which is a bullish sign, that we eventually get a strong break of resistance for a long trade. Now, that's not to say you can't use trend lines in this manner. Just be on the watch for the horizontal support and resistance zones that may cause a speed bump or even a detour. Now, there are going to be a few methods to draw your support and resistance zones, and you could question each of them. How do you know your lines are any better than random? Number 1, turn off the candlesticks or the bars in your chart. Number 2, just start drawing random horizontal lines. Number 3, turn your candlesticks or your bars back on. What are you seeing when you look at the chart? Do you see where prices bounced from your random lines? Do you see where price bounced a few times? Do you see where support and resistance even switched roles? Now, if random lines seemingly reject price, how will you make sure your lines are valid? Now, one way to determine your support and resistance levels is just to use basic market trend structure. Here's Murphy from 1986. Usually a support level is identified beforehand by a previous reaction low, and a resistance level is identified by a previous peak. A market in an uptrend will produce higher highs and higher lows. A market in a downtrend will produce lower highs and lower lows. A market in a range will produce both. So our rules for defining support and resistance levels are, number 1, some type of trending pattern, and this example here is an uptrend. Second, once a swing high is put in an HH, price rejects from price point resistance and then exceeds resistance. We'll mark that area as former resistance and potential support. Number 3, at point marked A, you can see we have a higher low and then a lower high. This negates the uptrend pattern, and you can see price has put in a triangle pattern. Number 4, at point marked B, price holds inside of the highs and lows and it's labeled a trading range. Number 5, price breaks the lows of the range, rejects off previous resistance, which has now produced a support level. You also want to note that price will not always return to a former reaction low as mentioned by Murphy. There will be times when price will return to the former area of resistance, and that zone will act as support as buyers enter the market. This is a simple and objective method to identify your support and resistance zones using pure market structure. You can also use prior day highs and lows, but with markets heading to 24-hour trading, Forex is already there. You may want to define the time you use for open and close, such as the 5 p.m. New York time. Now, don't get too caught up in exact price points with your lines. Remember, these are zones. Price is rarely perfect. Now, how a market reacts to support and resistance, it matters. In order to better understand the context extracted from the market's reaction to a level, it's useful to discuss an example. Now, this is an older chart of the ES primary session where prices were dropping in spite of the fact that in early trading hours, there had been an attempt at moving higher. Now, the first context was it wasn't able to hold above the prior session's high in the close. As price approached the prior day's low at 1620.75, selling was pretty decent. And given that the earlier attempt to go up had failed, there was reason to suggest that 20.75 would not hold for too long, if at all. However, at 1621.5, there's a quick turnaround in the market. Now, in the face of all that selling, the ES rejected Monday's lows before even getting there. It then tested lower a couple times without getting close to making new lows, and it held. And at this point, the chances of a move higher into the close were elevated. Now, in the end, the ES pushed 57 ticks from its low to its last high before the RTH close. Now, using this context to support you, there was money to be made given the context. Now, realistically, though, there will be times when it's profitable to take trades at specific levels. And as already pointed out, the fact that you are identifying market structure to define the amount of risk you're willing to take is certainly one compelling reason to use levels for entry. Now, sometimes levels work so well that it's not hard to see why traders can be convinced at their unconditional validity. However, if all levels were going to hold all the time, the markets would never move. So the question is that if you're going to enter at levels of support or resistance, which do you choose? When are they valid? Now, one determining factor you may use to determine a strong level is the amount of time the price rejected. That's not a really good trading plan. Hits on support or resistance levels actually weakens the level. Each time price revisits a level, stop loss orders accumulate underneath the zone, as you can see here by the increasing line thickness. These make prime areas for an influx of order flow as these orders are triggered. Now, depending on the amount of stop loss orders beneath the support line and the amount of breakout traders standing by, price can move fast and hard away from that level. And you can note by the green circles that once you start to see price not rallying far from the level, or price begins to base at the zone, extra caution must be taken if you're considering a trading opportunity. In order to trade at a level, it's important to see context, confluence, ideally other reference points aligning, and the right sort of trading activity on the approach all working together. Now, since we understand that all support and resistance levels can break, how do we take a trade from the level? Now, remember, support and resistance zones are market reference points that allow you to have some structure to your trading decisions at locations where there's a potential of price move. You don't have to trade support and resistance zones to get the benefit of them. Seeing how price reacts to these points can be just as valuable depending on your trading strategy. Now, once you've determined support and resistance zones that you're going to keep an eye on, the next stage is to watch for signs that the level will either hold or fail. Number one, a strong drop in price in a long tail candlestick, pin bar, kangaroo tail, whatever. It rejects the previous resistance, now acting as support level. We'd call this minor support since price had really not visited prior to this event. Second, this is the first peak, but it highlights a bearish candle that takes out the real body of a bull candle. That's a move that you could trade. Number three, another reject of support, now called major support since it's rejected price more than once. Number four, an engulfed candlestick at major resistance. Number five, price consolidates as support with an obvious resistance line. And number six, price then consolidates at the top of the range, which indicates bullish intent. And you can actually position inside of this smaller range. 7, lack of bullish momentum at resistance as shown by the smaller candlesticks. 8, range with obvious support and resistance levels. A strong break of support and price pulled back to test. After price breaks all previous support, a pullback trade sets up another shot to the downside. Now, this one chart example has shown many candlestick formations that you can look for at these zones. Now, false breakouts of zones are pretty common, and many breakout traders get nailed when price tests a level, appears to want to break it, and then just snaps back up. These are called false breakouts or failure tests. In this chart here, prices ran into resistance and pulled back. And you know that traders have been going short or exiting longs because price had not broken through. Remember we talked about it earlier. Protective stops are accumulating just beyond resistance, and the traders on the sidelines are waiting for price to break resistance so they can go long. At the right of the chart, price runs from the low end of consolidation after a small battle as indicated by the long lower shadow. Price pops the resistance area at the black arrow. Price had a decent run, but it eventually slammed back, almost closing below the open. So is this a sign of a successful breakout? No. By the looks of the massive bear candlestick that wiped out 3 days of gains, those that went long were getting hammered. And after a brief consolidation, hopeful bulls see the end is near, and the second huge momentum candlestick indicates the probability of other shorts entering the market and the bulls finally exiting their position. The false breakouts of support and resistance, even if you don't trade them, they tell a story that the zone is still of interest and acting as a barrier to price. And that may aid you in taking a trade short in virtually any trading strategy. Now, the general rule is not to short into support or buy into resistance. That's a rule that may be ignored, and price action is going to dictate your behavior. And this one here, this happens to be my favorite setup actually. A strong momentum move to the downside, price rallies, giving us a support line and resistance. Price drops back to support at the first green circle, but buyers hold the move. The second green circle shows sellers stepping in strong, but the slight drifting upwards after shows bulls holding on. Price drops, begins to consolidate. The last green circle shows price dipping below the support level of the range, popping back inside. Price is unable to gain traction to the upside, and this is a prime location to enter the trade. Price action has shown you that at this critical area, the bears are the ones holding the card. And your stop would not be placed just above the zone. Remember stop runs? But maybe you use an ATR stop as an example. Now you're positioned before the break, which means before stops are triggered and before breakout traders step in. And it's not uncommon to ride the wave of momentum and be up a considerable amount long before others get wind of the trading opportunity. Now, this assumptions that either levels work all the time or they are, as a trader at the beginning had told us, non-existent, are both. Once you understand what they really are, you'll see just how useful they can be, whether you day trade, you swing trade, regardless of the time frame chart you're using. Support and resistance zone, they're going to either hold or they're going to break. That's it. Find your own method of determining which ones have a higher probability of occurring. Just take action. Now, keep in mind that if a level breaks, you don't expect price to come roaring back inside the level. You expect pullbacks to the breakout zone to be weak. And this is where understanding what a failure looks like at the zone. Now, trading support and resistance is a viable part of a trading strategy. That includes risk management and, of course, trading psychology. Practice locating and drawing your levels and monitor the behavior of price when the line breaks and when it holds. Now, being hands-on is the best teacher. So crack open your charts and start perfecting your use of support and resistance trading.